Welcome to the Crypto Compliance Podcast by GateNox.
This is Crypto Compliance by GateNox, where compliance experts and practitioners are talking about current market events and general compliance aspects. My name is Paweł Kuskowski. I'm the host of the show. Today we have a special guest, Andrew Kimbrough, the Chief Compliance Officer at 1inch Network. Andrew has extensive background in fintech, crypto, private banking, and asset management. Andrew is an absolute authority in the field. He brings a wealth of knowledge and experience from traditional banking. He spent many years in HSBC, Citigroup, Deutsche Bank, and then he moved into DeFi and crypto. Andrew is your go-to person for navigating the intricacies of the regulations in these industries. In this episode, we spoke about how to approach compliance in DeFi and crypto, where to start where you are building your compliance program, AML program in these areas. What are the differences with traditional compliance, traditional finance compliance? Compliance approach to tokens with the example of 1inch token, and why there is a future in DeFi and crypto. In crypto compliance, we promote the highest compliance standard in crypto, bringing interesting topics and talk about practical issues. I would like to ask you to subscribe to our YouTube channel, leave your comment and share it. Let's together promote compliance culture in crypto and Web3. Please also check our website, gatenox.com. GateNox is the fast network and tailored corporate KYC solution. With GateNox, you can onboard corporate clients much faster by working in a trusted and compliant ecosystem with Web3 capabilities. Hi, Andrew. How are you?
Very good, Pavel.
Thanks for joining our podcast, Crypto Compliance Podcast. Great to have you here. I'm really excited, and with one very critical element that you have in the long term of, long tenure in crypto, is that you bring a lot of background and a lot of experience in traditional finance and bringing this into crypto world. But tell me more about your recent appointment. You are Chief Compliance Officer in 1inch Network. Tell me more about this.
Yeah, sure. No, first of all, thanks for having me, Pavel. It's really great to be here. I like your podcast. So 1inch Network is at its simplest it's a DeFi aggregator. So 1inch itself does not run liquidity pools, does not maintain AMMs on these pools. Rather, from my perspective, from a compliance guy's perspective, it is a best execution platform for trading on DeFi. So if you are trading frequently, or if you're trading larger size with more esoteric tokens that you only find on the various DeFi platforms, Uniswap, Curve, these guys, then you can go through 1inch and it will find the best pricing for you. Alternatively, it can also help you break up big trades if you're going in that direction. So it touches on both aspects of best execution, which is pricing, and also being able to break up big trades, and also just having access to tokens that you're not going to find on centralized exchanges.
So that's immediately there's a question, and I think that's big topic which is currently kind of hidden in the crypto compliance space is best execution, market manipulation, all this stuff. I mean, we all know that it's happening on the market on many centralized exchanges. There's a lot of this. But what you mentioned is best execution. That's Market in Financial Instrument Directive in Europe, Market Abuse Directive, a lot of traditional Transparency Directive as well. A lot of traditional, pieces of legislation, which should apply at some point, I believe, also to crypto. What's your view on this? I mean, and what's the state? I mean, you are registered in Switzerland, correct? I mean, for a foundation.
I mean, there's a foundation based in Switzerland, which the software development piece is built around, and then there's some other legal entities in different locations for different purposes. We're working on consolidating that down into specific entities to face specific regulators, because we've taken the decision at 1inch that we do want to move into the regulated space, that DeFi is moving in that direction and has to move in that direction, but we're working on, okay, how is that going to work for us? So it's still a work in progress, but that's part of why I was brought on to work on this project. With regard to like the regulatory framework, I mean, what we've seen up to now in the crypto space is an absolute micro focus on AML, right? That's for
100%.
example, in Switzerland, that's what we've done. It's like, okay, first things first. If you're a small crypto player, you're under a self-regulatory organization, and here self-regulatory organizations supervise you on the AML Act only. Right? They don't touch all these other things like market conduct, conflicts of interest, these other things that like MiCA are designed to bring into the crypto space. So what we're facing now is that we focused to a large extent on the AML aspects, and now we're having to look at, depending on your jurisdiction, obviously, we're having to look at the other aspects of being a financial intermediary, which is all these other pieces that I've just mentioned, including, which is very relevant to, say, our FTX friends, corporate governance, right? Having proper governance in place to show that you're actually managing your business. So, which is not strictly speaking something that a lot of people think about when you talk about compliance aspects of crypto or traditional finance, but it is there. I mean, it is part of the Banking Act here and in any other jurisdiction. So what we're seeing is that we're either being pulled or in some cases shoved in that direction. I mean, with MiCA, I see that as the way that the EU usually does things, strongly encouraging you to come to get into our box and join the club. Yes, it's going to be painful, but it's better than being excluded and then finding yourself sanctioned one way or another. So from my perspective, what we're having to do is expanding our view from just AML to all of the other aspects of regulatory compliance, which apply to traditional finance, which is not straightforward. And obviously for us, if you look at the DeFi space, the AML piece is itself not yet fully, let's say, bedded in. We're still, like we operate, most of the DeFi operators that I know of function as, they're permissionless networks. So anyone who has a wallet can, and the right tokens can join the club and trade on these on the trade tokens in these pools. Whereas now we're having to look at, okay, we can monitor these, like with your old shop coin firm, you can use tools like that, and different players are providing more and more tools for the DeFi space where you can monitor liquidity pools and see who's doing what. So to an extent, yes, we're covering that in terms of, let's call it transaction monitoring. But in the DeFi space, I see it as a combination, it's sort of a merging of transaction monitoring and trade surveillance. Right? It's what we see in the compliance space. So there's that piece done, but the part we're just struggling with, which is the ongoing issue that we're fighting in the crypto space and in the blockchain world, is who controls a wallet. Know your customer, KYC, source of funds, source of wealth, and then understanding what that customer wants from you, why it is that they're trading with you, so that you can then watch their trading activity and say, yep, that fits in with their KYC, or nope, we may have a problem here. We're still not quite there yet, and that's something we're going to have to build up and work on in DeFi.
100%, and that's when I built CoinFirm, I knew that this is going to be first, let's say, the source of, where is the transaction coming from? What's the history of transaction? Was there any, let's say, aspect of illicit funds, which you can see, immediately. But then, additional aspects is, and that's what we built right now in GateNox, right? Is like, where is the origination of the funds, all this stuff. So that for me is critical. I'm, glad that you say this. And how, when you say, you want to bring this, where is this movement coming from? Because when I spoke half a year ago with DeFi projects, all they said is, we are not captured by any of the regulations, it doesn't apply to us. This.
Yeah. We both heard this over.
Why it's actually changed? Right now, the amount of decentralized projects which are asking for type of solution, and same for NFT, same goes for NFT, which historically they said, we don't need this, and we are not captured by any. Well, you're transferring funds, it can be used for, I don't know, like terrorist financing, all this illegal stuff and not nice stuff. what you're going to say if something like this is going to happen. So why do you see this change? Where is it coming from? Is it coming from regulators, or is it just simply people maturing to this approach?
It's two things primarily. Well, it's the three that you've mentioned. From my perspective, it's primarily customer demand. So it is institutional interest in DeFi and in being able to trade on this space, either as a principal, like an asset manager or hedge fund, or on behalf of clients, say a crypto bank like the one I used to work for, Seba, Signum here, and other banks that provide crypto to their customers. So there's that element, which is key because they are, and whenever I say institutions, I mean financial institutions, financial intermediary, the terminology we use here in Switzerland. So these FIs, they have to be very careful about who they're interacting with and who they trade with. If you go onto a centralized exchange, they have AML standards, that they have a certain level of supervision. As I've said, they're not all yet supervised on everything. There's not a lot of market conduct supervision going on. Yeah. But, these guys have one foot into the regulated space. You can you can operate with them depending on the jurisdiction you're in. US is getting a little more tricky. If you're in the UK or EU, there's more tolerance. The second piece, which I think is, which you touched on, is a realization in the industry that we do need to move that direction. There's still the pure play crypto bros who say this is going to change the world. It's going to put all the banks out of business. Swift is going to die, and everything's going to be crypto. Well, sorry, fellas, that's not going to happen. What is going to happen is that this is going to merge, and then there's a gradual merger going on, a coming together of traditional finance, decentralized finance into something. And we can't, I'm certainly not going to look into a crystal ball and say, what is that going to look like? Because that's going to take years. But there's that realization. So organizations like mine, 1inch, like some of these others, in my previous life, we were doing some work with Aave. These other guys are looking at different ways that they can get into this supervised licensed space so that they can serve these big institutions. Because if you look at a traditional centralized exchange in the security space, it's predominantly institutional flows, right? There's some retail flow that comes in from retail brokers, but it's mostly hedge funds and these guys that drive it. And you want to be in that space. You want those kind of players pushing their volume through your product, because that's, from a business perspective, that's how you make the money. And as you mentioned, the regulators, we're seeing that certainly in the US, but in other jurisdictions where there is more and more regulatory emphasis, the regulators are becoming more sophisticated. The Bank for International Settlements put out a very interesting paper at the end of July on crypto risks. And they really hit a lot of the things on the head. Decentralized is not necessarily decentralized. There is a lack of corporate governance. Oh, surprise, surprise. Some of these other things. But the good news is that these and other publications from some of these guys is they're not negative, right? What the BIS said was know your risks, right? The Federal Reserve put out a couple of papers for their supervised entities and for banks that are at the state level in the United States supervised, which was you can do crypto, know the risks. Show us you've done a risk assessment across the board on, whatever it is you're doing, whether you're just custodying some Bitcoin for clients or you're actively getting involved in DeFi. Show us you know your risks. And when we come in for our supervisory exam, we can be comfortable that you understand the risks you're taking. So the regulators, we see that. If you're reading these publications, you see the direction that most of these regulators are going. Ex-SEC, which is doing something else. But there is definitely a push to get everybody in this crypto family that looks like an FI, which includes DeFi. You need to get it under a regulatory umbrella. It benefits everybody. Right now, a lot of folks in the crypto space don't see that, but it's going to help us make this a more legitimate business in general, and make it safer for the retail investor that we do want to continue to have playing in our space, to continue to play, to not have to worry about market conduct, market abuse, to not have to worry about some kind of conflicts of interest going on inside of the firm I'm trading with where they're going to go under. hack attacks on a particular DeFi provider's liquidity pools. It's happened. It will happen again. You want to know that there is some some third party is looking at these guys and saying, you guys are managing your risks. It looks okay. It's never 100% solution, but it's a matter of degree.
Yeah, 100%. And I see this change happening, and I completely agree with you that will be the best for the entire market to allow like big business come into crypto. This is where liquidity is going to come, and I cannot understand why there's any, where is the misunderstanding in crypto? Yeah, exactly.
Yeah, you don't need to be a compliance officer. You don't need to be a business development professional to understand this. This is where the flow is going to come from. You want liquidity, you got to bring the big boys in, and the big boys won't play unless you're licensed.
Yeah. And okay, so right now, let's move to your experience, because I see more and more people coming like with your experience of many, many years in traditional finance. So you've been with Citigroup, right? Citibank, then HSBC.
Deutsche Bank, HSBC, and then into the crypto space.
That's unusual. So tell me, how this change happened and what do you see the biggest differences or similarities?
Well, for me, the change really hit at the end of my time at HSBC, because the last about 18 months I was there, I was working on their digital program. So it wasn't crypto related. It was just more about having a more consistent digital offering throughout the bank, throughout the business lines, to offer to their customers. Different locations had different levels of sophistication of their e-banking platform, for example. So we were working on that sort of thing, and this really was of interest to me, because before banking, I was in engineering and had to do a bit of coding way back in the days before there was Excel. I've been around far too long, but this kind of brought back some of that desire to build something interesting and new. And as it happens, I sit in Zurich, so I'm just north of Crypto Valley. So I thought, hey, why not try this out? So there's an exit point at HSBC where it was like, okay, I've done what I've set out to do here. I think I'm willing to take the risk and jump into this crypto space. And so I moved into it, worked on a centralized exchange project, then went to Sabo, one of the two first licensed crypto banks in Switzerland. Crypto being, they can hold crypto on their balance sheet, they can offer certain crypto services to their clients, but they also offer fiat. So they're sitting in the middle of both worlds. And then more recently getting into DeFi, which is really, for me, the cutting edge of what's going on in this space.
Okay, and when there's a certain way to build compliance programs, AML programs in traditional finance, right? And there's more or less playbook how to do this. If you are experienced enough to know that there's playbook. Which is completely different conversation.
Fair point.
Right? Yeah. And so how you approach crypto, especially right now in DeFi, to bring what's in traditional financial institution would be the standard? How do you go about this? What's the steps you are taking?
It really is. It's a step-by-step process, and it's a process of looking at each of those different risk buckets and saying, okay, getting a view, kind of a horizontal view across, AML, market conduct, best execution, conflicts of interest, governance, whatever else. Looking at all those compliance risk areas and saying, okay, where are we going to have the challenges, and where should we start? Where should we really get things going? Clearly, the AML piece, you can't. That's where the biggest risks are. That's where when you are supervised. That's where you are subject to an audit annually on that, particularly when you're a bank. So it's really about looking at that. And from my perspective, the AML piece is the most challenging in DeFi, because you are, if I look at DeFi more generally, not just through the 1-inch lens, but just look at the notion like looking at a liquidity pool. Okay, how do you go about getting into that space, right? You can say, all right, we will set up a subsidiary, and we will set up an onboarding process. We will have that under some kind of supervision, and we'll put these pieces together. So we will know the customers there. We will be monitoring what they're doing, but they will be interacting with a pool where there could be bad actors interacting. And that's not to be, that's a very difficult place to be. I mean, based upon discussions that I've had in the past with the regulator here in Switzerland, there is still debate about, is that okay or not? I mean, I think, right now the place we're moving, within 1-inch is having that sort of separate subsidiary, and just due to the nature of our business, the way that we approach this, it's going to be more around, okay, we know who our customers are. We are going to monitor what they're doing and what's going on in the liquidity pools. And then we may decide to report certain things that we see in the pool, which may not be part of our customers' interaction. But of course, that brings up the challenge of, does somebody like Uniswap or Curve want a third party like us to be doing that? And, we haven't bottomed that out yet. So that's one of the challenges. The other approach is to look at it and say, okay, let's drag and drop, let's do like a shard of this particular DeFi platform, drag and drop that technology over and say, okay, now we're going to treat this separate piece, liquidity pools, all the usual stuff, except only licensed players can operate in this space. So you kind of ring fence it. So in effect, it looks a bit like a centralized securities exchange as it currently operates now, where these, if it's the New York Stock Exchange, if it's the LSE, the way they function is you as an individual cannot trade directly on that exchange. Only a licensed broker can trade on that exchange. So you have a series of licensed brokers plugged into the order book, and so the KYC risk is managed that way through the participants in the exchange. So there's that type of perspective on the DeFi space, treating it that way. But of course, that comes with the liquidity challenge. Yeah. To do that, then you need to get a bunch of big players lined up at the same time and say, okay, today we're starting, and you have the volume. And that's not necessarily the case. Having seen that, worked on a project similar to this before, it creates problems. So, I mean, right now, my thinking is go with the first approach, but then gradually, as you bring in the institutional volume, then over time you can move to this more ring-fenced approach. But that's just my opinion. This is not a set thing with 1-inch or any of the other DeFi guys I've talked to. So it is not easy. I'm not going to raise flag and say we've got the solution, because the customer identification piece is such a tricky bit, and you can't avoid it. It's in all the regs. It is in the FATF recommendations. So you either do it or you cannot operate as a licensed player. So we have to make it work somehow.
Yes, and I think, in my time in CoinFirm, we've done analysis on exchange. We simply map out, initially it was like 2017, 2018. We map out who is actually applying the rules on KYC, customer identification, all this stuff. So there's one bucket, and the second bucket is, anyone else, who do not apply any rules. The liquidity was on the unregulated, so anyone who wasn't applying. But if you look back, the survivors are actually in this bucket of regulated, who conducted proper KYC, who've done compliance.
That's interesting.
Yeah. And it's actually, there's another piece, and I spoke with Henry Balani on my podcast about this, is there's a lot of data which supports that compliance over longer time brings much bigger value to the ecosystem, but lack of compliance. And I think like when we talk about this from with compliance professional, that's pretty obvious for us, right? We understand this, but the market do not. That's something which is also so I think we are. I see the market right now being, okay, the liquidity is actually coming from the unregulated entities, blah, blah, blah. But I think this is drying up. And the next move is, exactly what you said. Is like, okay, we're going to have gradually going into the, professional markets, professional clients. And for them, the compliance aspect is critical, right? I cannot imagine that someone would be touching crypto without knowing, that all bits and pieces are actually, done properly. Yeah,
absolutely, fully agree with you.
And there's something that's similar. I don't know if this is same in SIBA, but I'm a client of Swissquote, and in Swissquote you have a list of exchanges which you can interact, and so it's almost like this. According to our banking standard, these are the exchanges which apply proper rules, KYC, AML, conduct, blah blah blah. And I think potentially something like this could happen in DeFi space, right?
Yep. No, that's the SEBA has the same approach. To my knowledge, Signum also has the same approach. They all implement them a little differently. For example, at SEBA, when you trade with them, they have a trading desk. So you interact with the desk, and they trade on your behalf they're the principal trader on these exchanges. At the time I was there was 4 approved exchanges what they obtained liquidity from. All big guys. So we're able to provide plenty of liquidity in the tokens that our clients wanted to trade. But as you say, Swissquote, they provide a list, and you can trade directly with those through their platform. Signum is going to have something similar. But I mean, that was part of showing the regulator here that you're managing your risks, that you're saying, okay, we're not going to trade, that some guy, Huobi, Binance were off because they're not quite there yet, and there's not clear intent that they want to get there. So it's a space you watch. You would like to be on those exchanges because they have lots of liquidity. Yeah. But the flip side is, and through using a tool like CoinFirm, like the tool that you were working on before, you can look at these exchanges and you can see the ones that aren't licensed, that don't have some kind of AML standards. They have a higher risk exposure to higher risk services through their client trading flow than the ones that are. So it's not huge, but it is 2% versus 4% of the total volume. Yeah, that's a factor of 2. It's still a small percentage, but you have to take that seriously as a regulated financial intermediary. You have to look at it and say, there's other options. We don't have to go over there. We can actually onboard a couple of other licensed exchanges that we're more comfortable with, that come out better in this kind of scoring, and get our volume through more exchanges.
And do you think it's going to be the push will be coming from the liquidity providers like yourself? But okay, you're going to have under pressure to do this type of choices, right? And then it's going to be cascading down, right? You need to have this and this in place, and then actually, it's happening. So it's interesting that how it's gonna happen. When do you think it's gonna happen?
Yeah, that's again, pull out the crystal ball. I mean, when are these still, I had, you can't call them really rogue exchanges. I mean, because they have certain, like Binance does have AML supervision in certain jurisdictions. I mean, so they have partially tried to alleviate that issue. But the fact is, it's really, it's a time game. If I look at, if you look at what the information that you can find, the OSINT that you can find on these sort of separate exchanges that aren't fully in the regulatory umbrella, you see things like they're losing their banking relationships. Yeah, banks are pulling their fiat services from these guys, and if you're in the crypto space, that's your lifeline, right? You have to have. I don't care what you say. You must have access to a fiat on and off ramp somewhere. You have to have it, because otherwise, guys like me, like you, we can't participate. That's just the way it is. And tomorrow, the whole world is not going to turn to crypto. I'm sorry to disappoint a lot of people. We're just far away from that type of scenario. So these guys, they're being pushed two ways. The business side, like you're saying, the liquidity, the bigger institutions, the banks, the asset managers that are licensed, who trade on who have crypto books and who trade on these exchanges, the less that they do with those guys, then that puts pressure on them. Further, every time that there is another SEC event, that there's another Department of Justice event, that there are quieter events in other jurisdictions where the enforcement culture is not around outing people and putting a name up and saying we're going after these guys. Like in the EU, these type of things happen. People are subject to enforcement actions. It's kept very quiet. It's kept quiet here in Switzerland also. Guys quietly disappear. There's not the perp walk thing that goes on in the US, but both of those pressures are going to box these guys in, right? Not having access to liquidity, to fiat liquidity, big players not wanting to trade with them, and the regulators coming in on top and saying, you know what, we're gonna prosecute you in our jurisdiction, and in worst case, put out a what is it? One of those an arrest warrant for you through the international system, and you could find yourself being picked up next time you go on holiday in Mallorca. I mean, it's just that's happened.
Andrew,
that's happened.
I'm going to cut what you just said. I'm going to cut this and I'm going to cut this and send this to DeFi projects. Wake
up, guys.
Yeah, exactly. But I completely agree with you. It's funny that they still. It's almost like we can still wait. We are in Switzerland. We are in Singapore. Nothing going to happen to us. Yeah, but yeah,
there's no waiting. There is no waiting. Because there's pressure everywhere. And several years ago, you could rely on going to some of the lesser known jurisdictions.
Yeah.
You could register in Malta. You could go to Gibraltar. There are some places that are quasi credible jurisdictions. There's the private banks operate there. There's plenty of proper financial intermediaries that are supervised there, but it's just not the same. Even when you go there, even if you get licensed, good luck finding a bank to bank you. Good luck. That's what's killing a lot of these guys. Yeah, you can go to the UAE, find a bank that'll bank you. Yes, UAE is very open to crypto. Both DIFC and ADGM have a good regulatory framework around it. It's very transparent, and they're much like I found them. I went through a licensing process with them on my previous job. I found them to be very similar to Switzerland. Yes, it's tolerated. Yes, you're going to follow our rules, and yes, we're going to fine you and sanction you if you don't follow our rules. So it's real simple, right? So if you go in there, they might give you a license, but then after you get the license, then you need to get the banking relationships. And if you have a bad reputation in other jurisdictions, it's very difficult.
One question, which is, big question, let's say, is why DeFi exists in crypto? Because, initially when I'm early adopter 2013, I joined crypto, then, built businesses and all this stuff. And there's there's a couple of risks. One is the anonymous coins, which I think, it's no longer the risk. And second, centralized exchange is going to be forcing to actually trade only, the liquidity will be only on centralized exchanges. And then suddenly we have boom in the, smart contracts, which led to the DeFi space. And why DeFi exists, in your opinion?
So in my opinion, it exists in the simplest terms, it exists to provide a market for illiquid assets. So in the crypto space, whatever they are, whether it's one of the multitude of new tokens, this comes out every day, every week, that needs a place to be able to trade. Even if they're not looking to be a payment token, it's just a governance token. You need a mechanism to exchange it, and you as a project probably don't want to be that mechanism. So you can you can set up on PancakeSwap initially, or on SushiSwap, and get a pool or two going in ETH and BTC, USDT against your token, and get some liquidity going, with the hope in the future that you might be able to get volumes up, to get interest up around your project, to then join one of these centralized exchanges. So to my mind, that's the main thing. It's really getting those guys up and running. Also, it is just for any kind of general liquid asset. If there's something that doesn't trade enough to be economically feasible for a centralized exchange, that is an option for you. You can find a market for yourself. From my own experience, looking, comparing one for one with the kind of the cryptos that are well known, that are traded both on DeFi and on the centralized exchanges. In general, order books give you better pricing, and they're more efficient markets. But again, if you're a smaller token, if you're for whatever reason not highly traded, maybe you're a project that's not looking to have large trading volumes, but you just want an ability for holders to exchange your tokens, then that's a great place for it. And I don't see a problem with that. I actually, from my perspective, centralized and decentralized world, in terms of just the pure crypto piece, taking out the fiat world, I think that there is a symbiotic relationship there, which can improve over time as we find our way in the DeFi space to bring that side of the equation into a more supervised box, because that's the only problem. But I think that there is a real place for DeFi. I mean, really, it's one of the reasons that I'm in it, for that reason, really. I mean, I think there's probably some other reasons, but for me, it is about being able to trade in illiquid crypto assets.
What about the transparency and the system resilience, which many claim when there's FTX collapse, all this stuff, that this proves to be better? What's your opinion on this? And then we have, on the other hand, hacks and rug pulls, all this stuff in the DeFi space.
Yep, that's it. It's FTX was big. FTX was a huge marketing house. They slapped their name onto this, onto that stadium in Miami. I mean, this was a high visibility shop. When it went under, of course, it's going to be in the media. Yeah. I mean, this is like politics in the U.S. right now. So you just see it all the time. Whereas a DeFi platform being hacked, we're going to know about it in our space because we read, we're going to be reading CoinDesk and these other outlets and communicating directly with each other. So we know when this happens, but it's not so newsworthy, but it's just as impactful. I mean, if you can't trust a particular DeFi operator to manage their pools properly, to have resiliency around the AMMs that they have in each of these pools, managing the liquidity, then eventually the money's going to go away. And sophisticated financial institutions, a hedge fund manager who's in the crypto space, is going to look at this. Whether it's in the media or not, these guys dig and do their homework, and they're going to say, all right, this DeFi guy looks pretty good. They haven't had hacks. I've talked to some of their principals, some of their software development guys, and had my tech guys go and talk to them. We feel pretty confident that they're managing their risks okay. As I said before, there's never a 100% solution, but they're managing it. That has to be addressed, because it's easy to point fingers at FTX or these other guys, say that's a centralized exchange problem. That's a centralization problem. No, it's not. All right. The problems are the same in the DeFi space, but they manifest themselves differently. Right. There is less of FTX, from my perspective, was a governance problem, which just flowed down and destroyed the organization. In a DeFi, you have if it's built right, and that's another key pointer. If it is built right, if it's truly decentralized, if it has the decentralized governance around it, like a lot of these players have, where it is transparent, where you can see the decision making around, let's allow this new pair as a new pool. Let's upgrade the contracts across the board on this basis. If you see that kind of process working, then yes, you don't have the governance problem, but you do have the technology risk around, can you trust this shop to not be hacked? There's no zero risk solution, right? This is what gets me about some of these crypto people. Yeah, there's lots of problems in the fiat space. Absolutely. Fractional banking is there's problems around that. There's issues. That doesn't mean in our own space, crypto, there are no problems. I mean, you and I know that. We're compliance guys, we're risk guys. I look at things in terms of what's my risk, and I look at these things, and it's like, yes, there are risks there, but they can be managed. And if they're managed properly, then you can convince regulators and you can convince financial institutions that they can play in your space and feel relatively secure in putting their own assets and their clients' asset at risk in your DeFi platform. Kind of a long ramble, but
that's good. And it's funny what you said. Is my good friend Joey Garcia is he's saying is that when there's like, oh, we don't have counterparty risk in the DeFi space, but then you have a technology risk, which you just said, so which is like, I'm not sure which one is better, in reality, because the tech, I think, is still, I don't know if, like you mentioned, Sushi Swap, and a couple of others. Was there anyone who wasn't hacked in like longer term, like from the DeFi space? Which one would you recommend, in terms of like security, because then when you say, oh, there's no one who wasn't hacked, okay, is the technology ready to be deployed for large amounts?
Well, there's guys who have been hacked, which are none of the ones that I've mentioned before, but they hacked and they had problems. I mean, there was impact on customer liquidity. Tokens were stolen. There are attempted hacks, and all of these guys have had attempted hacks, but they have robust resiliency frameworks around that type of exposure, the tech exposure. The cybersecurity risk, that they're able to manage it, right? We saw that at Seva, the guys at Signum see it. In this space, there's bad actors. That's just the way it is, and they're going to be looking for vulnerabilities all over the place. Not necessarily just technology, but that's definitely one of the key ones. And so, what I would say is you look for the guys that have, go to their website and see that they mention this by name, that they say, yes, we take cybersecurity risk seriously, and here's X, Y, and Z what we do about it, because the bigger guys do that. I mean, we 1 inch, we talk a bit about this, and it's important for all of us, because it brings the ecosystem into the mainstream, as part of how you get yourself into that sort of what I consider the holy grail, which is you're supervised, you have big volumes coming from institutions, and you're still taking full advantage of decentralization, right? Because it's and let's not kid ourselves. Decentralization doesn't mean no people involved. Yes, the liquidity in these pools is managed by a smart contract, and AMM, as we call it. Somebody wrote the contract. Do you trust them? Do you not trust them? This is it again, comes back to my bugbear about governance. You need to be very clear about governance. It's like one of the lawyers that I was on a panel discussion once, and he said, at the end of the day, across all these platforms, across all these exchanges, there is a person behind it somewhere, right? So as a lawyer, as an ex-prosecutor, the guy said, there is somebody I can prosecute. If you do something wrong, there is somebody to go after. There is no purely decentralized, nobody's involved, but just the people trading on it. Go away, grow up. There are people behind these things.
Yeah, and I tell you, story from CoinFin when I had a lot of engagement with FATF at the moment when they were writing, the virtual assets piece. So there's a lot of consultation, and I remember, I think it was Habuchi, the head of FATF responsible for virtual assets. And we spoke, and I said, we're signing with Tezos, we're signing contract with, someone else, from the token space. And they said, like, what do you mean you're signing contracts with, So who is actually you signing with? I mean, it should be decentralized, right? Like, how are they paying? I said, these are all valid questions. Thank you for asking.
Thank you for asking. Absolutely. Yeah.
Exactly. Yes, I completely agree with, but it's very difficult to say, even if I think Ethereum right now is slightly different, but, for a long time, Vitalik's influence over, Ethereum was such a significant one that he could probably say, we need to go into this direction, and, this would happen basically right now. Yeah. It's maybe different, but yes, I completely agree that, that's funny when you talk about, decentralization. And I say, coming back to DeFi. My idea, for DeFi and Web3 in general is like you kind of there are tools available and you can plug and play, almost with different tools. Like, 1inch could move liquidity from, one, pool to another. And it's almost like, they are there. They compete, but at the same time, they are all available. So it's interesting, interaction. And we also like how we approach identity and how, also including corporate identity, something that you should be able to almost like put your identity on blockchain. There's mechanism which gives you assurance that it's actually compliant. And then you plug in, someone can plug in, services around this. And, if you want to, you can access this. If you don't want to, so I think, the Web3 is actually like, interacting bodies, interacting projects, which completely like, I'm specializing in liquidity. I'm specializing in I'm specializing in, I don't know, like DeFi operations. I'm specializing in identity and all parts, so that's I
totally
think the biggest promise. Yeah.
Yeah. A lot of guys, you say Web3 and they say DeFi. And I think that's a lot of it. Right now, I think that's a very big piece of it, and I think it's very exciting. But as you say, like what you're doing at GateKnox, this notion of, okay, how do we make legal entity onboarding better? Because that is a headache. I mean, it's, I've lived it. It's so annoying because if you're facing an individual, then the identification piece is very simple.
Yeah.
If you're facing a corporate, it could be simple. It could be outlandishly complicated. So anything that we can do to make that easier is going to help. It'll help everybody. It'll help Web3. It'll help the DeFi space. It'll help centralized exchanges. It'll help TradFi, quite frankly.
Yeah.
Because this is something that needs to be fixed. And there's other, there's things we haven't even thought of. And that's how I see Web3. I mean, yes, right now the basis is DeFi, but as we keep marching along in this blockchain journey, other pieces are going to be brought into this, into what what can a financial institution's infrastructure look like, because it can be improved, and blockchain can make a big difference here, but it's a step-by-step process.
Yeah, I think you probably have as well, but I have a lot of friends in Latin America. And right now, what's happening in Argentina, I know that all of them are safe because they, like 99% of the money is actually put in crypto, in stable coins, everything. So nobody trusts, government. We don't realize in our, area of the world how important it is, right? To being able to access the money or being able to effectively, hide the money from the influence of the government, and I think this is something that it's not properly acknowledged in our, part of the world. So that's interesting one. Andrew, one last point, which is critical, and also, tapping on your experience, is 1inch token. Obviously, I know so many, and there's so many, let's say, different perceptions, let's say, on the market, on the risk related to, crypto tokens. Some of the, especially what SEC is doing is kind of really impacting the entire space. What's your view from compliance perspective? How do you see this?
Okay, well, I will, first of all, in the interest of good governance and managing a conflicts of interest, I am a holder of some 1inch tokens. So, I'm a member of that club, but I do have some other cryptos. I think from my perspective right now, we're struggling. The SEC has pushed all of us into a direction of asking ourselves, what are these tokens really about? There is in a place in like Switzerland, there's clarity, there's definitions, right? There's security tokens, there are payment tokens, and there are utility tokens. And you sit in one of those three buckets, and you can go to a qualified law firm here and they'll give you an opinion, and you can rely on that opinion. FINMA will say, yep, that makes sense. So depending on what your classification is, determines whether or not you need to be licensed and under what regime. So there's clarity. Looking at the states, there is not that clarity. We recently had the SEC say to Coinbase, everything but Bitcoin is a security. So you need to stop trading it because you're not a broker dealer, you're not a licensed exchange, you're not a registered investment advisor. So get out of that business. In my opinion, patently absurd. But it is a risk. It is a risk for all of us in this space, whether we are part of a project that has a token. And if I look at the 1inch token, it's not a security. It doesn't give me access to the profits of the firm. I can stake it like I can stake any other token and obtain some small returns from that. But that's certainly not something that under the Howey test would qualify as a security. And that's the same for most every other token out there. The only token that I can think of that's really, really clear is Bitcoin, because it's in the white paper. I mean, this is about changing how we do fiat stuff. And that's where it fits. And you can say that's clearly a payment token. In the Swiss perspective, it is not a security from the SEC perspective. So they've signed up to that. But these others, that have different characteristics, whether it's ETH, whether it's Matic, personally, I don't buy that you can apply the US Howey test to these and say with a straight face that these are securities, because they don't pay dividends, they don't pay it's not like a bond where they're paying some kind of fixed interest rate. You can stake them, but staking is, to me, it's equivalent to depositing to a savings account. That's not a security. Depositing to a certificate of deposit, that is not a security, right? That's taking fiat and lending it out and getting some return on it. It might fall under some kind of banking regulation, but certainly not securities regulation. So the stake tokens, okay, there's some arguments around that, but what the SEC is doing is not very constructive. What I'm hoping to see come out of this Coinbase situation, Coinbase has sufficiently deep pockets and smart people that I think they'll be able to come forward with these arguments and say, hold on, let's SEC, let's take your test of what is a security and what's not, and let's apply these to, let's say, the top 20 cryptos that we have. They are not going to be securities under the SEC's own test. But, right, it's their regulator, which means there's a political angle. There's no telling what various congressmen and congresswomen are hammering on Gensler about. But it is something, it does bother me. I mean, it concerns me because it is just not, I've been on the European side now for 17 years now. Well, plus another 4 that I was in the UK. So I'm more attuned to this principles-based approach and regulation. And so the regulation by enforcement that is carried out in the States, particularly by the SEC and the Department of Justice, is just inappropriate. I would rather see the SEC and even the CFTC come out and put guidance papers like the Fed did to their banks and just say, here's some guidance, understand the risks, communicate to us what you're doing, because that makes a lot more sense. That's what MiCA is about. Like, here's all the risks you need to cover, crypto guys. Show us you're covering it. They're a little prescriptive here and there. Makes perfect sense. But for the most part, just understand what your risks are and manage them. Right now the SEC has just thrown a spanner into the whole works and in creating a lot of aggravation for all of us.
Yeah, but you could argue that the SEC is saying, that the rules exist, you just simply don't follow. You know what I mean? It's almost like you are security, so you should follow the security. We don't.
You're security, so you're under securities law. Yeah, but you didn't bring this up when we first came and talked to you, because I know Coinbase has been in discussions with these guys since they started operating there.
So what would be? Yeah,
go ahead.
What would be your advice to compliance, people who are in this situation where there's proper business and there is token, which, I think in many situations is kind of, I see this as a community gathering, with certain function of utility, right? This is more what most of the tokens, which I think is excellent. And I think, this is like embedded in our crypto world, like deeply in crypto, that without a token, actually, it's very difficult to break through because, you need funding, you need something to attract, customers if you are in the retail space. So what would be your advice to other compliance officers who are kind of in the situation that we have a token?
First and foremost, my advice is do not knowingly operate in the U.S. This is real simple, right? I've had these arguments with banks when I was working in compliance at banks. The people, there's always this perception, it's a huge market. We need to go full on into the States. It's huge, it's fragmented, and it's highly overregulated, and the regulators are fragmented. It is expensive to go and do business there. I'm sorry. So stay away from it. I mean, obviously, in our space, you can't control who holds your token. I mean, that's against the decentralized, the notion of decentralization and anonymity of people holding tokens. I don't disagree with that. I don't think you should be going after a particular project just because somebody in Miami decided to buy some of the token. But do not, unless you intend to set up shop there and become licensed there, don't touch it. Don't sell yourself as being, U.S. based or targeting U.S. customers. Make sure in the T&Cs that are on your website, we don't do sanctioned countries from the FATF list plus U.S. Right? That always needs to be there. And there are some other countries that are tricky also. With the U.S. is the noisiest. The second one would be if you have a project, you have a token, know yourself what kind of token you have. Do the analysis, have it documented. How you classify your token. As I said, if you're based in this jurisdiction, or if you were somewhere in the European Union, I would say get a good qualified legal opinion on it. It's worth the money. Spend to get somebody who's in the crypto space, who the regulators trust, because they're involved with the regulator, and get those guys to tell you what it is. And I mean, if they tell you something you don't want to hear, too bad. Then you maybe need to adjust your business model, but at least you know. But don't do this, right? Don't stick your head into the sand and pretend it's not there, as we did in this space. Let's say 3 years ago and before that, which is, let's pretend it's not there. We're decentralized. You can't find us. Yes, they can find you, and yes, you need to be prepared for it. So certainly, first things first, know what your local regulator's expectation is. If you're in Germany, if you're in Switzerland, if you're in ADGM. Understand their regs, understand what they expect, and meet those expectations. Because if you can do that in your core market where you've set up shop, then you are well placed to be able to then expand in other markets and credibly do that. I mean, that's what we did there. We were licensed here, went to the ADGM. They said, "Yep, you're a license there. We'll give you a license here. You will be supervised by us. You will be subject to our regulations as well as to whatever you have in Switzerland. But we trust you because you've gone through this process and you've demonstrated you've done the risk analysis." Same thing. Know your risks. Go through, do the risk assessment. Be prepared to put it in front of whoever wants to ask for it. Whether it's a sophisticated bank that wants to trade with you, or whether it's just a regulator, banging on your door and saying, "Hey, we kind of think you're doing some business in our jurisdiction. Could we talk to you?" Be ready for those conversations. And you may not get what you want, but you're less likely to be prosecuted, to be sanctioned, and to create problems for yourself in your home jurisdiction, right? If the DOJ comes after you in the States and you have no presence there, guess what? Your home regulator is going to come banging on your door and saying, "What the hell are you doing? Why is the Department of Justice in the United States coming after you? Why is the FCA in the UK asking questions about you even though you're not there?" It's just, don't go that direction. Be clear about where you're operating, from where you're operating into where you're operating, and make sure you have your risk assessment in place, because you'll always be hit with the questions. Again, there's no 100% solutions. You always need to be prepared for those unpleasant surprises. But if you're prepared, then you will more likely to come away with a not fully negative outcome with the regulator, because it's never positive with those guys, right? It's always, they come in the door and they check you out. They're paid to find problems. But just make sure they don't find material problems that you haven't yourself identified and are managing.
Yeah, 100%. And I think the critical element for crypto, and that it's decentralized and it's global, right? So that's something that it's very difficult to even understand, comprehend all the risk which you are exposed to, right?
Yep.
operating globally and having global clients. But I completely agree that there's certain things that you can almost like put in place and make sure that it's your mode effectively against anything wrong coming. Do you think that Switzerland is the best place currently to do crypto business, or?
Yeah, loaded question. Well, I mean, I obviously like being here. I've been here for 16 years. I think it is a very good jurisdiction in terms of the regulatory environment. As we say, they talk about Switzerland being crypto friendly. That's kind of the marketing pitch. Reality is it's crypto tolerant. And that's the way some other jurisdictions are. The EU's like that. It is crypto tolerant. You're allowed to do crypto here, provided you operate within certain parameters. You obtain licensing if they think you need it or not. So I think that there is regulatory clarity here. There are professional organizations, law firms, consultants, players that are already here, like Seva, like Signum, like crypto finance, other guys who have been here doing crypto for a long time that you can tap into the network and understand how it works. And it's a good launch pad into other jurisdictions, because this is traditionally, if you look at the private banking tradition of Switzerland, it's always been a place where it provides services from here into other jurisdictions. So there's already an awareness, even particularly with the regulator, around how to do cross-border business and how not to do it. And that can be very helpful, I think. If you operate in a place like the US, there is no awareness. There's guys in Miami and New York operating, holding accounts with clients in different places where they really shouldn't, but there's no awareness of cross-border there. So it just, there's strange things that go on sometimes in the private banking business. But here, there's clarity. And as I've said, I mentioned the Emirates before. This is an interesting place because they've done what Switzerland has done and take it maybe one step further, in that they have some specific. They've done what Switzerland said, which is, here's all the regs. All these regs apply to you. If you look like a financial intermediary, then this is going to apply. We're not going to write a bunch of other stuff. They do write guidance notes. They do write circulars. Like travel rule, which is a whole topic unto itself. There is a circular which defines how you can do that in Switzerland. So the difficult topics, they provided some guidance on. UAE, ADGM, which I'm very familiar with. They're like that. They have all the different pieces for the different risk areas. AML, banking regs, various other risk buckets. But then they also have a specific for virtual assets. So virtual, call them BASCs, but it's virtual asset guys that are offering crypto services. There's separate body of regulation there. So there is a lot of knowledge, and the regulators there are, in particular in ADGM, they've incorporated a lot of, they tried to drag and drop English common law into the ADGM jurisdiction to make it easier for all of us, like, guys like me, like you, that have worked in the traditional space, who have been exposed to that, right, either through the US or the UK. How that kind of thinking works, and so they've installed that. DIFC also, they haven't done quite the same thing from a regulatory perspective. They're an older jurisdiction, so it's more mature, more players. But for my money, if I was going to start a firm, I would start it here, and then I would be looking to move very quickly and start up also in the Emirates.
Yeah, I remember in 2018 or 19 when we had meetings with ADGM, 50% was Brits. Like former FCA, former government, it was very, very interesting, so yeah, I completely agree that this is, definitely good jurisdiction to do business in crypto. Andrew, last question. What's the most exciting for you in the crypto space in the coming years? Where do you think the next growth gonna come? And what's the future, let's say, of crypto in your opinion?
So for me, it is around more institutional adoption. We've been talking about that for years. We're not quite there yet. We have some, but not a lot. We still don't have the proper liquidity.
Do you think we need different products for this, like property linked tokens, anything of this type, or what's available in the market is already interesting enough?
I think that there is, so for example, securities fractionalization, which has been, it's something we talked about a lot on the exchange project I worked on. That is a big value add. So being able to fractionalize, big, large cap shares with large pricing and fractionalize that so it's more accessible, it's more tradable. I think that's good. I think what you're talking about, which is getting a hold of, was being able to more easily trade illiquid assets. So like real estate, I think it's a very interesting place. I think that would definitely help with institutional adoption to be able to provide those, because if an institution's looking, they say, well, all you have is crypto. And over here on the traditional side, I've got structured products, I've got hedge funds, private equity, real estate, FX commodities. I've got all kinds of cool toys to play with that have different correlations that can help me do my job, either for myself or for my clients, whatever your business model is. But I see your point, and I think you're right in that we do need to look at how we can securitize more products that can be traded on the blockchain, because it's a great tool. I mean, this blockchain based, the transparency around it, the reduced what I want to say, a settlement risk that you have with blockchain takes time. Sometimes that's another issue altogether. But the fact that you can have some kind of certainty about trading these things is very important in my opinion.
Okay, that's perfect. So I think we stop here. So Andrew, thank you very much for your time. This was excellent.
It's great. Thanks a lot, Pavel. Appreciate it.
Thank you.
Crypto Compliance, brought to you by GateKnox.